What the hell is going on with Tesla? It's been down for the past 3 months from almost 290 to 107. But seeing this, it made me think of a trade, how you can turn your stocks into a GIC. What's a GIC? A guaranteed investment certificate. So usually banks offer that, where your capital is completely safe and they give you a guaranteed interest rate. Usually, I think right now it's turning around 3 to 5% maybe for a GIC at the bank. But here's a way you could do it with stocks, synthetically, sort of. I'll show you how. It's going to require options, and it's going to require 100 shares of the underlying. So I'll give you an example with Tesla. So let's say you're looking 1 year out. So if you're looking for a certain return, guaranteed return, for 1 year, and you want to apply this strategy on Tesla because option premiums are high on Tesla. So let's look at the covered call for Tesla 1 year out. Now, right now the stock closed at 109, but pre-market, or not pre-market, sorry, after hours is trading at 108. So let's look at the call for January 2024. So that's exactly 388 days away. So let's say 1 year out. And let's say we were to buy Tesla at 109. And then in return, we sell a 110 call for, you can see around here, last sold price was $32. So if you bought, let me bring out the calculator here. So if you buy 100 shares of Tesla for 109, but then you sell one call for $32.40, your net cost is $76.60. Now, what does that mean? So when you sell a call, it only means that by expiry, if your call is in the money, what does in the money mean in this case? If Tesla is trading above your call strike, in this case, the call strike is 110. If Tesla is trading above 110 at expiry, what's the expiry? The expiry is January 19, 2024. That it only means that you're going to have to sell these shares at the strike that you selected, so the 110 strike. So if Tesla's at 200, let's say, by January 2024, that means you're going to have to sell your shares for 110. How much did these shares cost you? Well, they cost you 109, but you sold a call for $32. So they actually cost you $76.60. So by January 2024, if Tesla is above 110, you're going to end up making a return of 110 divided by 76.6. So what is that? 110 divided by 76.6. So that's a return of 43%. If Tesla is anywhere above 110 by January 2024, that's 43% return on your investment. So that's in theory. But now in practice, Tesla can continue to drop. So it's not a guaranteed return for sure. Tesla can be below 76 by January. Who knows? Tesla can even go to zero. Unlikely, but still a possibility. So if you want to make this trade safer, you could pick a lower strike. So instead of selling the 110 call, you could sell the 90 call. So let's say you were to sell the 90 call. So first thing, you buy shares for 109, but then you sell the 90 call, which, as you can see here, the 90 strike is selling for $42.70. So minus, you'd collect $42.70. So you're collecting more, but your strike is lower. Your strike being lower, meaning that if Tesla's above 90, anywhere above 90 by expiry of January 2024, you have to sell your shares for 90. You don't get to take advantage of the capital appreciation. If Tesla's at 200, you don't get to sell it at 200. You'll have to sell it at 90. So that's what selling this call would mean with your 100 shares. So the first thing you have to do is buy 100 shares and then sell one call. It's called a covered call. And in this case, with the 90 strike, your net cost for the trade to enter the trade is $66.30. And your return by January 2024, if Tesla is anywhere above 90, so 90 divided by 66.3, your return would be 35%. So it's lower than the other scenario, but it gave you room for Tesla to drop a little bit. That would mean that you've got room for Tesla to drop. You've given yourself a bit of downside protection of about 90 divided by 109, which is 1 minus 82. So you're giving yourself room for Tesla to drop another 18% in 1 year, and you would still make a 35% return on your investment. But we can take this even further. We can sell an even lower strike. Let's see what strike is available. So let's go straight to 50 or something. So if we went with the 50 strike, you would collect $67. So let's try this out. So 109 minus $67, that puts your net cost at 42. So if Tesla is anywhere above the strike, which is 50 in this case, anywhere above 50 by January 2024, which is ours, the expiry that we selected. So 50 divided by 42 gives us a return of 19%. So that's not bad, actually. You won't get that in any GIC at the bank. So a 19% return in 1 year with a downside protection. So Tesla can still drop all the way down to 50 by January 2024, and you would make that return. So Tesla can drop from 109 to 50, so 50 divided by 109 minus 1. So Tesla can drop another 54% in 1 year, and you could still make that 19% return. Now, in theory, it looks beautiful, but obviously in practice, if it's probably priced in, if the premiums are that high, it's probably for a reason. So it's possible that Tesla could drop that much in 1 year. Who knows? But if you feel super comfortable that Tesla's not going to drop all the way down to 50 in 1 year, then that's an easy 19% return on your investment with downside protection of 54%. But as you can see, after hours, Tesla's still dropping. It's moving a lot. Something's going on, but I don't know what it is. And then let's say you did take that position, a covered call at a 50 strike, and Tesla ends up below 50. Well, you still have the shares. You have the shares with a net cost of 42. So it's as if you bought Tesla for $42, but you did waste a year because you thought you were going to make a specific return, but you ended up holding shares at $42 without really generating a return. So even if Tesla falls below $42, which is your net cost, worst case scenario, you just wasted a whole year without gaining anything. But yeah, you definitely would have had a better entry if you had waited. That's all that would mean. But obviously, it's hard to time the market. You really don't know what the best entry is. But just showing you a type of strategy with options called covered calls that you can use to sort of turn any stock into a GIC or a guaranteed investment certificate by giving yourself a bit of downside protection and by selling an in-the-money covered call, basically. So to sell a covered call, you need 100 shares. If you already have the 100 shares, then you just have to sell the call to open, sell to open a call. If you don't have the 100 shares, then you have to buy the shares and sell the call. You could do it in one step. If it's a US stock with Questrade, you could do it under one step. You just select covered call, you select the strike that you want, and it'll be a net debit that you're going to pay. And then your return comes in when you close the position. If I look at the 50 strike, for example, you could see it's showing around $40, but that's because the stock is trading at 107 after hours. But in my example, I was using 109, so it should be around $42. So if I click on this, it'll open up the order entry window, so I can buy the trade or enter the trade and buy 100 shares of Tesla at 109, but then sell a call option at a 50 strike for about over $67, making my net debit what you see over here.